Looking at the one-year charts for Micron, Western Digital, and SanDisk, we are immediately confronted with the sheer unadulterated violence of this bull market. We are witnessing a historic vertical re-rating where companies once dismissed as cyclical component makers have exploded into multi-hundred-billion-dollar infrastructure titans in a mere 12 months. The data does not lie. In May 2025, Micron was trading at a modest $80. Fast forward to May 2026, and it has crested the mid-500s, a staggering 500+% explosion that turned a $70 billion market cap into a $600 billion cornerstone of the global economy. The catalyst was the memory bottleneck. AI models grew so hungry for bandwidth that the memory wall became the most lucrative trade of the decade. Looking back at those stock prices, and for some viewers feeling the sting of regret, might leave you in a state of pure fear of missing out. But identifying the next squeeze before the street wakes up is the difference between chasing a rally and building actual wealth. For investors that flagged this memory bottleneck right before the fuse was lit, that conviction has now been paid out in multiples. But the smart money has already moved on. As we navigate the back half of 2026, the bottleneck has migrated. The crisis is no longer just about storing data. It is about the physical survival of the cluster. Big tech is projected to dump a record-shattering $725 billion into AI CapEx this year alone. And that capital is hitting a wall of thermal and connectivity limit. If this is your first time here, my name is Martin. I've spent the last 3 decades navigating the U.S. equity markets, and in the next few minutes, I'm going to share with you exactly how I'm positioning capital ahead of what could become the next trillion-dollar companies. I want to make the best use of your time. So, let's start with 3 specific stocks we have identified that are currently trading at market caps, reminiscent of where Micron sat just months ago. The infrastructure ghosts that are essential for the 2026 expansion. Let's begin with our first high-conviction play, Nebius Group, ticker NBIS, a company that is currently being massively misread by a market that is pricing in risk while the business is de-risking in real time. While the retail crowd is busy chasing the top of the semiconductor cycle, Nebius is quietly building the specialized AI bunkers where those chips actually perform. The stock has already surged over 50+% in the past year, closing at over $150. Yet, the underlying fundamentals suggest this is just the opening act of a massive re-rating. Nebius operates as a neo-cloud provider, offering high-octane infrastructure that serves as a premium alternative to traditional cloud giants for massive AI workloads. Their business model is now significantly de-risked thanks to multi-year commitments from Microsoft and Meta, providing the kind of contract visibility that usually commands a much higher multiple. The scaling metrics here are simply mind-blowing. The company has tripled its contracted energy capacity in just a few months, moving from 1 gigawatt to over 3 gigawatts. This physical expansion is backed by a rapid site rollout, scaling from 7 to 16 data center locations to handle the tidal wave of demand. Management is now targeting a run rate revenue of $7 to $9 billion by 2026, a goal supported by a cleaner balance sheet and lower leverage than its closest peers. Despite projecting 600% year-over-year revenue growth for the first quarter of 2026, the market remains cautious, often focusing on potential deployment delays rather than the sheer volume of demand. However, the operational efficiency is already showing up in the numbers. The cost of revenue has dropped from 60 to 30% as the business scales, with a forward valuation that compresses sharply to a 3.4, which is 4 times EV to sales by 2027. Nebius is trading at an attractive level compared to its growth rate. Much like Micron did before it hit its stride, the market continues to view this as a prove-it story. But when you look at the contracted capacity and the shift from single sites to massive regional clusters, the gap between price and value becomes undeniable. Moving to the second powerhouse on our list, we find Credo Technology Group, ticker CRDO, which is the primary architect solving the urgent connectivity bottleneck that threatens to stall the entire AI supercycle. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps me out and it lets me know to make more content like this. All right, let's get into it. The stock has surged over 280% in the past year to trade close to $180. Yet, it remains one of the most misunderstood plays in the entire networking space. For a while, the market worried that the rapid shift to optics would leave copper-based solutions behind. But Credo has completely flipped that narrative. They have transformed from a specialized component maker into a full-stack platform that owns the entire transition from electrical to optical connectivity. The financial momentum here is undeniable. In their latest fiscal third quarter for 2026, Credo delivered $47 million in sales, representing a 200% increase year over year. Even more impressive is the underlying profitability. The company reported a 68% adjusted gross margin and generated $140 in free cash flow. Maintaining a 34% free cash flow margin while growing at triple digits proves their absolute dominance in active electrical cables. These copper-centric solutions remain essential for short-distance server connections within the rack, where they are still the undisputed leader in efficiency. The major strategic catalyst, however, is the recent acquisition of Dust Photonics. By bringing silicon photonics in-house, Credo is verticalizing its tech stack and eliminating the core bear case against the stock. This move de-risks the long-term story as data centers transition toward 1.6 terabytes and 3.2 terabyte speeds. They are building a massive moat around the connectivity bottleneck by combining their optical digital signal processors with these newly integrated circuits. In fact, customer demand is so intense that management has already pulled forward the production ramp for their zero-flap optical modules by 2 full quarters into early fiscal 2027. Credo is perfectly positioned to capture both the steady expansion of the AEC market and the 35% compound annual growth rate that is expected in optics. By controlling the technology that moves data across the cluster, Credo is staying at the very heart of the hardware squeeze, proving that the connectivity wall is actually its greatest expansion opportunity yet. Rounding out our high conviction list is Vertiv Holdings, ticker VRT. A company that has undergone a massive transformation from a traditional industrial supplier into the absolute backbone of the AI data center economy. The vertical move on the chart is breathtaking, with the stock climbing over 245% in just the last 12 months to reach $300+. This isn't just momentum. It is a fundamental re-rating of what it means to be a picks and shovels play in the 2026 AI supercycle. Vertiv is no longer just selling hardware. They are solving the thermal and power problems that currently stand as the biggest physical barriers to AI scaling. Next-generation GPUs are now drawing a massive 1,400 watts per chip, pushing thermal design power to levels where traditional air cooling simply fails. Vertiv is meeting this crisis head-on with a $15 billion backlog and a dominant position in the liquid cooling market. Their performance data confirms this dominance, posting a 30% overall organic growth rate and a mind-blowing 44% organic growth rate in the Americas. These figures effectively distance the company from traditional industrial manufacturers who typically grow in the low single digits. What makes Vertiv uniquely compelling is its aggressive shift toward high-margin integrated systems like OneCore and SmartRun, which provide modular prefabricated data center blocks that can scale across multiple generations of silicon. They are successfully pivoting away from one-time hardware sales and into day-one service revenue, providing predictive real-time maintenance through their AI-powered Next Predict platform. In a world where a single rack overheating can interrupt a synchronized GPU's training run and waste valuable computing time, having Vertiv experts on site from the first day creates an incredibly sticky revenue stream that can last for decades. Perhaps the most significant future catalyst is their deep collaboration with NVIDIA to design the reference architecture for the next generation Vera Rubin AI factories. As rack power densities surge toward 200 kilowatts, Vertiv's verticalized liquid cooling portfolio is the essential infrastructure of choice. With a massive backlog and upgraded 2026 guidance pointing toward adjusted operating margins of over 20%, Vertiv is positioning itself as the indispensable infrastructure giant, quietly powering the entire digital economy. Let me know which stock you're buying below. Either way, thanks for watching, and until next time, this is the X-Invest Hunter. My name is Martine, reminding you that the best investment you can make is in you, and you only have to be right one time to change your life forever.